Hello and welcome to F5 for Kids, a podcast about guiding your kids on the path to financial independence and extraordinary lives. I'm your host, Dominic DeLaquil. Our guest today is Fadi Habib. Fadi is the founder of the Legacy Wealth Builder Academy, an education and coaching program where they teach smart and safe investing, then allow students to practice with no risk while they learn and build confidence in their skills, so when they finish the program, they have a strategic way to generate consistent income, protect their investments, and build wealth responsibly so they can create financial freedom on their own terms. Welcome, Fadi, and thanks for coming on the show.
Hi, Dominic. How are you?
I'm doing good. How about you?
I'm great. I just came back from a vacation in Egypt, and I'm feeling great.
Yeah, good. I'm glad you had a good trip. So let's start with what you learned about money when you were growing up.
Okay, that was a long time ago, but so I grew up in a mid-income family, and some of the things I learned as I grew up is that money is hard to get, right? Money doesn't go on trees. You got to be careful because it just doesn't come easy. Like that's kind of the general theme. Also, because I have a little bit of a religious background, there was some kind of negative connotation to it in terms of if you have a lot of money, then there's something wrong. It's either you're some kind of evil part in it, or you got it in a way that is not fair or normal or ethical. I think that's the main two things. Wasn't really, I cannot say it's positive, right? Like the vibe was, we don't need money. We don't need a lot of money because it's bad. And I want to be good. So we shouldn't be having a lot of money because we want to be good, as well as it's very difficult to get.
Yeah.
That's the two theme that I remember.
Yeah. Now, was it something that was talked about much, or that's just the mindset that you got?
Yeah. All good.
So you're Coptic, right?
That's correct.
Yeah. Sorry, that's just interesting for me because I have a background in St. Louis, and I grew up Catholic and also spent some time with some. I had a friend who was a bishop in the Greek Orthodox, or actually the Slavic Orthodox Church, and we would have conversations about all kinds of different things, and so that's that's an Egyptian Christian branch of Christianity. Is that right?
Yeah, Coptic means Egyptian Christian. And I gotta say that it's not really the religious stand that money is evil. It's kind of the culture.
Yeah.
The religious stand is that as long as you're not relying on your money, you're good. Like there are a lot of saints that are rich in the heritage. So I don't think it's a religious thing. It's not the official religious church stand. It's the culture thing. It's just the people of Egypt think. Like, I guess because most of Egypt is poor, they kind of developed that, you know what, I don't need to be rich because they're all bad. It's there's all these contradicting things at the same time. So the church is not saying, I never heard it saying that rich people are bad or rich people are evil. They're saying if you're relying on your money too much, or like you think that's the most important thing in life, then that's bad.
Yeah, right. So
the
then
culture
that becomes kind of the thing that the thing you'd be worshiping, so to speak, rather than the religious beliefs.
Exactly.
Yeah. No, I think I ask about that because I think it's so interesting both religiously and culturally and sort of in families, just how money so many times isn't something that's talked about or taught, but yet kids are still getting all these messages and making of them what they will. And then it takes a lot of us a while to sort of work our way out of limiting or beliefs about money that sometimes can be at cross purposes. So it's interesting that, even in Egypt, there's a similar sort of a mindset. For people who don't have much money, it's a common thing, I think, to be like, well, then that's a bad thing. And those people are bad if they have too much money.
I think, like, it came to me right now. I don't know if you're going to allow me to say it, but I think the topic of money is the same as the topic of sex.
Yeah.
We don't talk about, though the father or mother should be talking about money and sex to their kids. And because it doesn't get talked about, then the only source is I just have to figure it out by myself. Either talk to my friends or I'm going to get it from TV. Like, it's all sorts of really unreliable sources to teach somebody something that is that important. I think there's a lot of similarity in both topics. money is not as a taboo as sex, but it's still the same. Like there's not a lot of talk. I guess part of it is that the parents don't know how to make money. So how like, the parents are kind of defeated in that topic, right? So what is it that I'm going to say to my kid if I don't know how to make money? So how can I speak to my kid telling him or her that it's easy to get money? That's not how I feel. And I can't lie about it because I don't know how to make money. It's very difficult for you to make money. So I think it's part of the defeat of the parents that this is not a place whereby there's triumph, there's like victory in that arena. So I'll just not talk about it. I guess that's part of it.
Well, and then it just kind of keeps perpetuating, right? I mean, so if the parents don't have basic financial literacy, and they're just, especially if they're maybe lower middle class or working poor, or they're more challenged financially, and they're working their backsides off to make ends meet, and they never learn stuff about money, then I think that's a great point you bring up. Then how can they feel comfortable teaching their kids about money when they don't know much themselves? So yeah, interesting.
And I was mid-high class, so mid upper level. And just to add to your point, yes, of course, families will have this challenge, but also mid-high families that are only relying on being an employee. So if, like, my father was a doctor, but he doesn't know anything other than being a doctor. Right. Every time he goes into a small business or buys a property or something, because he did not lack any skills. He did, like, the myriad of courses that we have right now, and there was no internet. So it was very difficult back then to actually learn. So I will give him that. So, but he always speaks about any kind of investment or a business with negative connotation because he wasn't successful at it. He didn't go into too much. So I also see it in people who are so much bounded by the employee mentality and the employee lifestyle. Again, the only thing that they tell their kids, same as people in Egypt, is that just go get some good education, get a good job, right? That's it. There's nothing much to it. And anything else is actually fiercely discouraged. So if you don't go after a job, like if you tell, like, again, even in my life, when I go and venture into real estate, for example, the family, like my mom and son, like, why are you spending all that time? Like, you should be with the family. Are you sure you need to do this? And especially in the beginning when I was not that successful at it, all this advice that I need to come to the right path, focus on my job and my family, because it's a world that they are not used to and they're afraid of, and they have been really discouraged from, because it seems like being an employee is the easier way to make a living. You'll never be wealthy, but at least you'll be living. So that's also another element. There's only one way to make money.
Yeah.
Just focus on your job. That's it. Like, that's it. Take any job, but focus on your job.
Yeah. Well, it's safe and easier to understand. Sure. I mean, that's a good point too, because I think that's also very common and not the worst advice, but it's incomplete advice when there are so many other things that you can add on top of that. So an education and a good job can be a great foundation with which to bring in some money that then you can use to grow more wealth. But if you just stop with the job, oftentimes, and you don't know anything about spending, then oftentimes you might earn more and more money as you go throughout your career, but then you're just spending more and more. You're never getting ahead, and then you're working until you're 65, 70 years old, and that's that. And so that's, again, it's not bad advice, but it's only the beginning point in my mind, and it just leaves so much other things left out there to be taken advantage of.
Having a job or being an employee is never bad. For 99.99% of us, that is the starting point. The bad thing is that if it gets looked at as the only way, or it has to be the main way all the time, right? There's no more pleasure in life if you open your own business. But if the environment around you or your family or you talking to your kid as it is too risky, and you always, like, you gotta train him, educate him or her, but don't forbid them from doing it, right? So that's the bad part. Having, like, for me, education for my kids is a must. Like, even if we're like multimillionaires or even if we are billionaires, education is a must, because that's the foundation of a person. It teaches you how to think. So you have to start being an employee and understand systems and listening to your boss and talking to people. That's skills that you cannot go without. However, I will not discourage them. I will actually encourage them at some point of time to go. So actually, some companies, Dominic, allow people to go for 6 months to try something and come back if they fail. So basically, the same idea. If one of my kids want to try something, um, of course, they have to have good education and start getting few years being an employee. But after that, if they want to venture, don't be a voice of discouragement or like, it's difficult and he or she knows it's difficult. Yeah. So don't forbid them from doing that. Like, it's not a bad thing.
Yeah, I know. I think that's so important, right? Not to discourage them, whether it's intentional or even unintentionally, because we all have to find our own path. And part of that is making some mistakes. And it's much better if they try some different trails, so to speak, when they're younger and realize, nope, that isn't for me. It's better they do that when they're younger than when they're older, middle-aged, they've got a family and more responsibilities, and then it's harder to risk things, and the consequences of inefficient time going in a direction that isn't the right one are just heavier than they are when you're younger. That's the time to experiment and figure out, oh, okay, here's a path for me. Because oftentimes, especially at that age, right, when you're a young adult, you don't even know what all the different options are for you. And so doing some experimentation is a way to learn about those things. So I think that's really great advice. Whether intentional or unintentional, I think it's important not to discourage your kids from trying different things so they can find the path that's the best one for them.
One of the things that I learned about Warren Buffett I was trying to figure out why is he so good in what he does? Why is he so rich? And of course, we all know that he knows how to invest. But what I found out is that the first time he bought a stock was at 11 years old. He, by I think the age of 15 or 17, had about 7 businesses. So think of this, a guy who has multiple businesses, like one of his businesses that he didn't call it businesses then, but he used to buy, the game machines, the big game,
like the video
Pac-Man
games,
and stuff.
pinball games.
He used to buy them, video games, get somebody to fix them and sells them again. He has this newspaper business. So this skill, the fact that he was involved in so many businesses, allowed him to evaluate businesses properly. And this is one of the reasons he's so successful at it, because he's not like me, who was very sheltered. Like the first job I had was after I graduated from university. That's normal people in Egypt. They don't allow you to do anything other than just your studies. That's why I have a lot of respect for the North American system, is that people get to work as soon as they go into university, even before university, because it adds so many to the depth of their character and the value of money so the earlier you get your kids to be involved in a business and getting your daughter or kid to sell lemonade and figure out the math, it adds so much to their character, to the knowing the relationship with money. Anyway, and we can learn all from Warren Buffett. This is one of the reasons he's so successful. Of course, he's patient and he's good and smart and all of this stuff, but also this dimension of him of owning 6 or 7 businesses and buying the first, he got, I think, 3 shares at the age of 11 from the business he went in. So he was involved really early in this entrepreneurship and investing world.
Yeah.
And
evaluating.
And I think that added a lot.
So, yeah.
Yeah.
Yeah. No, that's cool.
Yeah.
Today's episode is sponsored by Venture Valley, a Singleton Foundation program. Venture Valley is an esports-style video game. It's multiplayer, and it's based around business creation, so it's fun to play and compete while you learn business and financial basics. You can find Venture Valley at venturevalleygame.com. It's totally free. And thanks to Venture Valley and the Singleton Foundation for sponsoring this episode. So I want to talk just a little bit more about a little bit of your background and then how you transition from that into other things. So you've got a background in higher education. Tell us about that real quick, and then where you went after that.
So very quickly, as a normal person in Egypt, I had to get good grades. I graduated from engineering, worked in oil field, manufacturing, high tech, BlackBerry, and then was a director in an insurance company. And then after that, I've been for about 6 years or 7 years, have been teaching in some colleges and universities. So that's how I like basic hits is just normal propagation to my corporate career. And I went into education because number one, I was told I'm very good in teaching. I like it. Number two, the lifestyle of what I can do with teaching is that I can teach online. And one of the things that I wanted to do is I wanted to structure my life whereby everything I do is online, which allows me to have location freedom. There are 12 kinds of freedom, by the way. Financial freedom is just one. The financial freedom gives you a lot of things. One of it is location freedom. I can be in Egypt and I have classes. I had that. I had classes at 1 a.m. in the morning, but again, I'm happy with that. So in the morning, I'm in the beach, and then like once or twice a week, I'm having a class. I don't like the 9 to 5, but that's me. I went out of it. Don't get me wrong. I've been 25 years in the 9 to 5, but the education itself is really nice. The higher education, because I don't have to be anywhere from 9 to 5. I can be there in the class time, but I can do the marking at my own time. I can do the preparation at my own time. I don't have to be there, and this gives a lot of flexibility for me. Somebody like me, I like to work at night. So I give my hours if I need to give my hours, and I have the flexibility too. So this is where I came to higher education.
Okay. And then from there, you did real estate for a while, but not you weren't doing in stocks early on. You were real estate first, right? Is that?
So let me tell you, so it's not that I started the investing journey after that. So my life, like it's not in sequence, it was in parallel. So in the morning, the 9 to 5 has never been really 9 to 5 because they usually ask you for much more than the 9 to 5. But anyway, so like I remember when I went into BlackBerry and they gave me this BlackBerry, I was so happy that they gave me a free BlackBerry. I did not understand that now I have to reply to emails 24 hours a day. So when I was very young, I graduated from my 5-year engineering program at 20. I think at 22 or something, I read this book, Cash Flow Quadrant, which is a really, really good book. Really nice read. All the kids and the parents should read it because it opens your mind.
For people who don't know, sorry, Fadi, I know there's a little bit of delay. Sorry, I didn't mean to cut you off.
Yeah, go ahead. Yeah.
I thought I had a second there to insert. So just for people who don't know, that's part of the Rich Dad, Poor Dad series by Robert Kiyosaki. So I think it's the second or third book in the series, and it talks a lot about being an employee or being an investor or a business owner. So yeah, great book. I agree. Cash Flow Quadrant. Anyway, go ahead.
Yeah, it's called Cash Flow Quadrant. The whole series is good, is really good. But like if there's one you read is Cash Flow Quadrant, it opens your mind, you and your kid, that there are different ways other than being an employee. And so I was an employee all of my life in the morning. And then at night, knowing that with the knowledge of the Cash Flow Quadrant, I worked on myself. So I had kind of another job, another project after work, which is I need to learn about real estate or stocks or investment or business. So lots of trial and error, because if your parent is not a guru in real estate, you will have to learn yourself, right? You have to take the responsibility of doing it yourself. So I went to a lot of courses and I started in real estate really early, like 25, 30 years ago. And only 15 years ago, I had this idea, as I shared with you, that anybody who invests in stocks is not a responsible investor. Okay. The reason I had that is that everybody around me was losing money. So it has to be gambling. It has to be like not a right way. Because for me, investing is not about the hype. It's not about you being so worried about what you did, right? Any kind of behavior that mimics you buying a lottery ticket, not really knowing what's going to happen, really afraid, that's not responsible in my head. So everybody around me was treating the stock market as a casino. And they're losing right, left, and center. So for me, as a responsible person, that's kind of not what I want to do. But I was pleasantly surprised when I went to this course, and I wanted to go to this course because somebody told me go there, and I wanted to go there to prove to myself that it's BS. Basically, it's all I'm doing the right thing, and this stocks thing is just a bunch of waste of my time. But I was pleasantly surprised that they put the first seeds into. Really, no, there is a system. And if you look really at the gurus like Warren Buffett, forget about the majority of people. If you look at Warren Buffett, he is so relaxed all the time. He is happy if the market goes up, and he is not sad when it goes down. He's actually happier if it goes down. So there's a method, there's a way. And of course, when I went into options, now I know that you don't have to wait 35 years to get what Warren Buffett is having. But this was my turning point. And I took something like 10, 15 courses because I really when I put myself into something, I just dive deep. So I took 10, 15 courses and I was pleasantly surprised. And I took the best out of each course. Has its positives and negatives, of course. And I from all of these, I had my own system. I figured out what was missing from the first course I took. And I had the system now that I can teach to other people. But the bottom line is you don't have to gamble. You should not be gambling at all. When you're buying a stock, you're buying a business. It's the same as a rental property. There's no one who is responsible who buys a rental property who does not ask first, what is the price? What is the mortgage payment? What is the rent? What is the, vacancy rate? How much are the utilities? In this area, do people pay the utilities? And they make some math and figure out if this is good or bad. It's the same thing as the stock. You're not buying a lottery ticket, you're buying a business. So there are ways to evaluate the business, figure out what is a good business versus not, because I don't want to buy a bad business. I want to buy a good business. And nobody buys a rental property because their friend told them, Fadi, go buy this rental property. It's good. Okay. And I'm going to go buy it. No, of course, nobody does that. Even real estate investors, sophisticated ones, when they go to the stock market, for some reason, they switch to be gamblers. I'm not sure why. I think why, because there's not a lot of people who teach it properly. And also in the world of stocks, there's so many courses that goes with the hype of day trading, double your money in 6 months. All of this, really,
hit it big quick, man.
unrealistic, unethical, unrealistic things that will make you lose. Day trading is a very quick way, very efficient way to lose your money very quickly. Avoid.
Because your first priority is mitigating risk and not losing money, right? So you have even though you're doing options trading, you take a very conservative approach. Maybe that's not the right way to put it, but
in real estate, correct. In real estate, the real estate market is not that volatile. So people usually who invest in real estate before have no idea that the same rules in real estate doesn't really apply that much in stocks. In stocks, they're very volatile. For the majority of people, that's a source of fear. When you see a stock going up and down, the market will really panic. If you really understand the market behavior, it goes up and down. It breathes. We know that every 3 years it goes up, and 1 year, units of time. Every 4 units of time, 3 units will go up, 1 unit will go down. Overall is going up about 10 to 11% per year. So overall is going up because why? Because businesses are making money faster. That's why the price is going up. And it has a different behavior than the real estate market. The cycle is very different. It goes up and down. And when it goes down, it is normal. It's like your kid inhaling and then exhaling. If the mother doesn't understand that exhaling is normal, she will think that there's something wrong and she will try to fix the kid or get a doctor to the kid. The normal behavior of a person who is not savvy about the stock market is that if you leave yourself to the normal psychology, you will buy at the max and you will wait till it goes down, panic and sell. Everybody. And that's why everybody was losing money, because this roller coaster of a stock price is going up. You think it's going to go up more. So you buy at the max, and then it goes down. You panic. You don't understand that it's going to go up again if it's a good stock. So you wait till it goes down and then you sell. So for example, Meta at some point was $380 at the beginning of 2022, $380. It's a very good stock. Good stock for me means pumping a lot of profit, have a lot of cash, little debt. All of this stuff was there in Meta. It was $380. At the end of 2022, it was like $80. And everybody was selling because they thought it's going to go down more, which might have gone down more. But everybody that I know that really good was finding every dollar they have to buy it at 80 because it's cheap. So when you know what is a good stock, and when you know that part of the market behavior is that in the stock market, short term means 2 years, long term means 5 years plus. Peter Lynch, who's a very, very good investor, said that there is absolutely no correlation between the price of the stock and the value of the stock. What does this mean? You can have a really good company and the price of stock is going down. Why? Because in the short term, it's just about emotions. So if people are afraid about something that has nothing to do with Meta will go down. So if they're afraid about COVID, if they're afraid about the war in Ukraine, if they're afraid about the Middle East war, if they're afraid about Iran fighting with Israel, if they're afraid with two countries having an epidemic somewhere else, stuff that has nothing to do with the sales of Meta, they will be fearful and the market will go down. And Meta will go down with the market. So in the short term, what I tell my students, think of it as a drunk person drinking all night, waking up in the morning, putting prices on the different stocks. It has absolutely no logic. There's no logic to it at all. And sometimes a bad stock you will see going up, just because of the hype.
Right. Because of
In the long
the
term,
psychology of all the various people out there in the market that are just responding based on prices of stocks and what they think is going to happen versus what Peter Lynch was talking about, which is the value of a stock, which is more aligned with the value of the company.
correct. And there's 100, the second part of the sayings, just to complete it quickly, there's 100% correlation between the value of the stock and the price of the stock long term, which means if Meta is a good stock, in the short term, don't try to figure out why it's going down or up. In the short term, nobody can predict what happens because it's just a bunch of drunk people buying and selling. But in the long term, we know if it's a good stock, it's going to go up in the long term. So right now, Meta is at $700, which was 80. So knowing that, we can capitalize on a lot of opportunity. The market will give you opportunity to buy something at a very discounted price, when everybody else will be screaming of the market is down and this is so bad and stuff. It's a complete different paradigm. If you know the value of Meta and you know it's a good stock and you see that's $80, you're not going to be crying with everybody else. Everybody else will be selling. You'll be thinking, how can I buy?
Yeah, it's a bargain. Well, look at this great bargain. Yeah, sure. That makes sense.
Exactly. Yeah, it's a bargain.
Yeah. So explain options investing then. And so just give us a little, if you can give an example of what, like a put and a call, right? Just sort of explain briefly how that works.
Okay. Very difficult to do it quickly, but let me try. So the word option means you can choose to do X or Y. You have the option of choosing. Okay. In the world of options, the buyer has this right to choose whether to do X or Y. Okay. So I can come to you, Dominic, and the example I always say is, Dominic, sometimes I get some ideas about businesses and I need to talk to somebody. So I want to go into a contract with you, Dominic. I'm going to pay you $10 for the right to call you anytime in the next month if I have an idea. And if I call you, you have to pick up the phone and we're going to just discuss my idea for 5-10 minutes. Okay. So I'm the buyer of the option here. I'm going to pay you. You are the seller of the option. I'm going to pay you $10 for the right of calling you whenever I need to. Okay. You, Dominic, are the seller of the option. You don't have the right. You have the obligation. If you go into this contract, you will have the obligation to take my call if I decide to call you. Okay. So that's kind of a very simple way of doing it. Selling puts is like insurance. You have car insurance. You paid, how many years have you paid car insurance?
Well, I don't know, a lot. Many
Correct.
decades and decades.
And do you think that whatever you paid in the car insurance is more or less than the times you claimed something? Like, let's say
certainly paid more in insurance than the claims.
You paid much more. You paid much more. So here you bought insurance, right? And if I am the insurance company, I sold you insurance and you paid me premium every month. It's the same as you're buying a put and I'm the insurance company, I'm selling a put. It's the same thing, but instead of cars, it's for stocks. So let's say you bought Meta at, $500, but you're so afraid that Meta will go down to 480. You can't handle it, right? And you don't know if Meta is a good stock or not. So you come to me and you say, Fadi, I know that you buy Meta. You think Meta is a good stock and you buy Meta. Can we agree together that if Meta went down below 480, that you're going to buy it from me at 480? Because you're so afraid, you want insurance that if it goes before 480, I'll go. From my point of view as a seller of a put, I know Meta is a good stock. So I know on the long term it's going to go up. I know $500 is a good price. I want to buy it at 500. So when you come to me telling me about this arrangement that if it goes below 480, I will have to buy it from you at 480, I'll say this is actually even a better deal. I will buy it at 480 versus 500. Not only that, if I go to this contract with you, you're going to pay me $10. So effectively, I'm buying it at 470. So high level, it's selling puts is the same as selling insurance. And selling puts has 75% chance going your way, or the technical term, the option will expire worthless. Same as the cars. You're buying the car insurance, but you really was not involved in an accident for in the last 20, 30 years. You paid much more in premium. So chances are, like we're stacking probability on our side, chances are if I'm selling the insurance or selling put on a stock, that it will go my way. Of course, there's a lot of risk mitigation as comes to it, which is I only sell insurance on good stocks, right? selling insurance, I'm not going to sell it on a bad stock because I don't want to be stuck selling insurance on a bad stock. So much more important than making money is how to protect your capital, is how to make sure that you don't lose your capital.
So Fadi, so in that example, right? So the reason you would agree to buy my shares of Meta, right, at 480 is because you think that's great. That's going to be a bargain because I know that Meta is going to go up again. So if I buy it from him at 480, so I just have to wait for it to go down. I'll buy it from him at 480. And then what I'll do is I'll just wait again. And when it goes up to 5 or 510 or 550, I'll sell it. And I've just made money, right? Because you wanted to buy it at 5, but basically you gave yourself even more by agreeing to this contract. Plus the fact that I paid you $10 for the obligation to buy that if it went to 480. Is that about right?
So there's different avenues. One way is what you said. The other way is I made $10 just for going into this contract, right? If Meta did not go down to 480, let's say it stayed at 500, I will not buy it, but I made $10.
Oh, sure.
So I can make money collecting $10, not by buying Meta, by just agreeing to buy Meta. You see the difference?
Yeah, sure.
So that's a revenue stream. That's income generation without me doing anything, without buying anything. But if I get to buy it, I'm happy because I wanted to buy it at 500. Now I'm going to buy it at 480. All what I'm going to do is I'm going to wait till it goes up to 480. I don't even have to wait till it goes up to 500. I'm going to wait till it goes to 480. And by the way, there's another way of making money while you're waiting for it to go up called selling covered calls. But anyway, so I'm collecting money while waiting for it to go down and collecting money while waiting for it to go up. Sometimes I will have to buy it, but I don't even need to buy it most of the time. And I'm collecting money just by my knowledge that knowing that Meta is a good stock and that 480 is a good price, and I'm willing to buy it at that price. That's it.
Okay, so this is really interesting. So it's a little bit complicated if you're not familiar with it at all, but it's obviously not something that a normal person couldn't learn if they put in the time and energy or had a good place to go learn this sort of stuff. And I want to get back to your protecting yourself from losses. I want to come back to that, but since we're in the middle of this right now, but then the things that you're explaining now, which you can see how there's more levels to that, and it's at least on the surface when you don't have a way to sort of hold on to it in your head, it's going to seem complicated. But this is what you teach at the Legacy Wealth Building Academy. Is that right?
Yeah, it looks very different because it's very new of a concept. Nobody really talks about that, right? It's as if I'm talking Chinese a little bit. But in my 12-week mentorship program, I get people to do 3 trades every day. By the second, third week, it becomes a second nature. The word put, call, for me, it was very difficult in the beginning because it was all new concepts. It's a lot of new terminology, which makes people shy away a little bit. But I can guarantee you, it's something that anybody can learn. Like I have people in my program that are 70 years old and some are like 30, 40. So anybody can learn this with a little bit of time.
Well, and you bring up a good example there. And the analogy in my mind is, right, so you studied engineering. There was a point when that was new, when you're trying to learn all these things in different terminologies and different equations and stuff so you can understand the larger concept, right? Your dad was a physician. I'm a physical therapist. There was a point when I was in physical therapy school where all these different medical terminologies and all these different things you have to sort of learn and start to memorize, it's a lot to take in and process all at once, but once you start to get it, then you can start to see the bigger picture and how it all fits together. And it's complicated, but it also becomes sort of routine at the same time, right? So anything that's...
It becomes routine.
Yeah, so it's no different a process than most people go through when they're going to university to get that job that we talked about earlier in the episode, right? It's the same thing.
Yeah, it's the same thing. If you hear something over and over again, it does not become that foreign to you after a week or two or three. So it just, you need to immerse yourself in it a little bit or get interest in it so that you can hear a lot of, but I can sympathize with people who first time hearing about put on call, like it's too confusing. And even the example, I try to make it as simple as possible. People tell me that I simplify it a lot, but I understand that it's the first time you get it. You might not get it. What I'm saying, insurance and stuff like that. I'm trying to make it as simple as possible. It's like insurance. You're buying insurance for the car. The insurance company is making so much money selling insurance to you, and anybody can look at their life and figure out how many accidents they did and how much money they paid in insurance and how much money the insurance company made them. So it pays if you are the insurance company. That's what I'm saying. But of course, you cannot be stupid. You cannot go insure the houses that are in the hurricane belt or
Right.
insure the houses that in a flood area, because you're going to make a lot of money, but at some point of time when the flood comes there, you're going to go bankrupt. So very important for me, I tell everybody, before you, like, instead of putting all your effort in trying to make money, you need to spend 3 times the units of time understanding how do other people lose money in the same circle. And that's how very important that you know how to not lose money. And losing money here, one of the main things is if you insure bad stocks.
Sure.
Right? You're going to lose money because it's bad.
So I want to talk about your growth system in a second, but before we get into that, so at the Academy, you're teaching people how to evaluate businesses, right? So they can determine whether this is a solid stock or not. You're teaching them all the different sort of option things that we're talking about. And as they go through that process, you also have they're part of a system where they get to do practice trades, right? So they're able to, it's like in physical therapy school, right? We would do things sort of on each other as students. And that way, if you didn't quite sort of understand what you were doing, you weren't gonna, there was no real risk involved, right? As opposed to, oh, you're working with this patient, you don't know what you're doing, and then you hurt them somehow or let them fall or whatever. So I think the practice component of your program, I could see how that would be very appealing to a lot of people, because as they're trying to get their heads around these concepts, then they're able to practice them, and that really helps them connect the dots better, but they're not risking their own money while they're doing that. Is that right?
For me, you should not be investing with your own money if you just learned about a new concept, especially with options. So there's something called paper trading account, which you can open for free. You don't have to fund the account. You don't have to pay anything. And they give you $1 million in IBKR, which is the brokerage I use. They give you $1 million fake money. So if you make money, you don't take the money home. But if you lose money, you didn't lose anything. Mm-hmm. And that's the proper way to try something new. So if I'm teaching you a new strategy, you have no business going from paper trading to live trading. Live trading means your own money before you prove to yourself that you can make money with this, right?
Yeah.
If you're not making money with this, it means that whoever is teaching you did not teach you properly, or is giving you wrong advice, or you're making mistakes. Still, you need to debug all of that and fix all of that in paper trading before you go to live trading. So in my program, every week, everybody shares their screen with the trades, and then that's different than the theory. We talk about the trades and ask them questions. How much money did you make? Did you really violate the rule that says X, Y, Z? I see that there's a mistake here, and everybody's thinking. And that, like when I do a lot of polls and surveys to figure out what is valuable for the students. And this is the most valuable thing. It's not the theory. It's not that I'm answering Q&A. It's this. It's the fact that we talk about the trades and they learn from me talking to them. Sure. So it's a completely immersive thing. And they go out of by week 9 or 10, everybody's talking about, I want to go to live trading. I discourage people the first 2 months to do any live trading so that they can just calm down and focus on the learning. Yeah. And then by week 9 and 10, everybody is already made a lot of mistakes, already proved to themselves that they can make money, and they're really excited to go to live trading.
Yeah. And that's really great. That's really cool. So, and you just go through the growth system, right? And that's an acronym. So what that stands for, just to give people a little bit more context of how the program works.
Very quickly, G is for having the right goal. So I'm in Toronto. Montreal is about 6-7 hours of driving. If my goal is to get from Toronto to Montreal in 1 hour, I will have the wrong goal. Why is it the wrong goal? It's ambitious, but why is it the wrong goal? Because if I really want to do this and I need to drive, I will have to drive at 700 kilometers per hour to get to Montreal. it's just a matter of time till I'm going to involve in an accident, right? Even if the first 20, 30 minutes I wasn't involved in an accident, and I will be involved in an accident. So same thing with money, with investing. If you have a wrong goal, if you want to double your money in 6 months or a year, it will push you to do stuff that are stupid and very risky, because ROI and risk are two faces of the same coin. Okay. If you don't know about the risk or you're oblivious about it, it doesn't mean it's not there, right?
Yeah, good point.
Think of yourself as a 2-year-old crossing the street. You oblivious about the fact that there are cars that can kill you doesn't change the fact that you'll be like, it's a very dangerous situation. So it's a balance between risk and ROI. If you just look at ROI, the only thing you're going to be looking at is ROI, you will end up buying a lottery ticket, because you pay $5, you get 5 million. But there is a risk that 99% of the time you're going to lose your capital, because it's a gambling thing. So we talk a lot about risk in everything we do, and how to intelligently weigh the ROI and risk. So that's why I tell, so that's all about goal setting. It's very important. And then the second thing is R, which is research stocks, understanding what is a good stock and if the stock is cheap or expensive. BlackBerry at $4 is an expensive stock, and Meta at $600 is a cheap stock, because we have to figure out what is the intrinsic value, what is the real value of the stock. Third is all about options. GRO is about options, understanding options, the mechanics of it, to the point whereby it's not foreign to you anymore. W is win through practice, practicing in paper trading. That's a very important pillar, because if you have all the knowledge, you don't practice, you got nothing, right? And then psychology is very important, and then habitual learning at the end. So that's kind of the main elements of the different things. And I assembled that from all the courses that I took, right? Because some courses will just talk about options without talking about stocks. So I said, what do I need to be successful if I'm going to go back to it? And these are the different elements that I assembled.
So, it's really cool what you've done, Fadi, and how you've taken different interests and experiences and skills throughout your life to sort of combine them. This, because you can see how, when you're talking about how you're doing the teaching and running the learning in the academy, how that ties in with your higher education background. That's just all really cool. And I think there's no one right path for everybody. So this isn't going to be for everybody. Some people, it's going to be like, I'm sure that's great, but I don't want to spend my time that way. And I just want something simple. And that's okay. Investing in a whole market fund is still better than not investing at all. Right? But for people who want to try and optimize and really enjoy learning more, this is a great way for them to learn in a safe environment, learn with others, right? Get the mentorship from you, so that then they can optimize and earn a better return on their money. They can generate some ongoing income in the process, but also build wealth for the long term. So they can do a little bit of both. And one last thing is that for parents who have kids at home that are still minors, and they're teaching them about money and they're starting to teach them about stocks, if this is something that one or both parents were interested in and learned, and they wanted to share this with their kids, or maybe even just one of their kids who seemed to really have this sort of an interest, they could set up a custodial account for them and then do this with their kids together. So it's not that the kids are prohibited from doing it. It's something the parents could work with them on, and again, in a safe way that they would manage. I mean, so there's lots of options for people.
Correct. And it can be in paper trading, so you don't even have to have money in the account, right?
Yeah, cool.
And they can start with something very simple. If you just buy the SPY, which is an ETF, this is kind of a basket that has the 500 big companies. The average of the SPY in the last 100 years is 10 to 11% compounded. That's doubling your money every 6 years. So it's very important for the kids to start early. Because I'm doing these options, and I'm telling people, if we're going to get involved and spend 10, 15 minutes a day to do this, you should be expecting something more than 10 to 11%. Again, if you just buy the SPY, you should be knowing that long-term wise, you're going to have 10 to 11%. That's why for me, anybody who's getting 6, 7%, for me, it's a crime. Because if you just buy the SPY, you do nothing. Just if you buy the SPY and go travel for 10 years, come back, or 15 years, it's going to be compounding by 10 to 11 years. If you're going to go and be a little bit more involved, you need to get paid more. So I expect from my students, and what I tell them is that you should be expecting 24 to 36% plus per year, 2 to 3x, because we're involved, we're spending some effort. I need to get because what is the purpose of me spending time doing that and getting less than the market? The market will give me 11. And like if I do nothing, it doesn't need any intelligence if you just buy the SPY. So they have this, you have the SPY or QQQ. So if you don't want to get involved, open a paper trading account for your kid and show him, look, with $1 million monopoly money, buy some SPY, buy some QQQ. I just let them be. Of course, you're not going to get the money at the end of the day because it's paper money, but it's a starting point to wet your feet.
Yeah. Yeah. And well, just to teach them the concept. So, and that's, and that's great that, and I think I'm glad you brought that up, right? That the expectation should be, because this is a more active approach and you're not spending a ton of time, but it's more active than, a SPY or VTI or something. But then you're expecting, and that's a great rate of return, right? If you're looking at 24 to 36%, that's significant. So that's really great.
I'm telling you, I'm doing much more, but I'm not typical because but the reason this is why I start with the G, goal setting. It should be 24% till the point whereby you can evaluate the risk and ROI, right? The same trade can be very good for one person, or can be really bad for another person. Depends. If your portfolio is $1 million, you can elect to choose one or two risky trades. But if your portfolio is only $10,000 and the $10,000 is all what you have, you gotta be a little bit more careful. So I'm very risk averse and I have no appetite for me or anybody who follows me to lose money. So we have to be really thinking of, we talk more about risk than how to make money. Making money is only 10% of the equation. Same as riding, like driving a car. Any fool can drive a car in terms of making the car move. Just push the gas pedal and it will move, right? But you know that we're not going to give license to somebody who can push the gas pedal. The whole game of driving a car is what? Is to not to be involved in an accident. That's the whole game. That's 99.9% of what you're doing is can't be involved in an accident even if the other person is not doing their job. So that's the same thing, right?
Yeah. No, that's a great analogy, right? Because that's true, right? And every parent with a teenager, I think that's their whole focus is teaching this kid how to drive that car safely. And a great point, even when other people aren't always doing what they should be doing, right? The whole teaching defensive driving. So I think it's really cool that that risk mitigation is such a big component of what you teach to just help people so that it doesn't become gambling and people are learning how to optimize and make a better return on their money, but not doing it in a risky way. So that's very important. So I think that's really great.
Very important.
So where can people find you? So if people are interested in the Academy, where should they go?
So the Academy name is called Legacy, and the word legacy, just quickly, is the fact that if you learn it, you can teach it to your kids, right? So that's the legacy part. So Legacy Wealth Builder Academy. So my website is Legacy Wealth Builder Academy, but I also have a lot of socials. So you can follow me on LinkedIn, Fadi Habib, FADIHABIB, or Facebook or Instagram. My YouTube channel as well. It's Legacy Wealth Builder Academy. It has a lot of videos and has a lot of interviews and testimonials from people who went through the program, so you can hear about their experience and what was difficult for them, what was easy for them.
Yeah, no, that's great. I will put all of that in the show notes so people can just click on those to make it easy if they want to search out the Academy or find you at any of the socials. So thank you so much, Fadi, for coming on. Thank you for what you're doing. I think it's great. You've provided this educational resource for people to just sort of help them do better. So, thank you very much for coming on the show.
Dominic, thank you. And it's my passion. I love it. I tell people all the time that even if the course was for free, I would still do it because I get a lot of joy from freeing up people because like everybody's struggling with this.
Yeah. Well, and it's especially cool, I think, because you started from a place where you're like, investing in the stock market is bad. That's gambling. Those are crazy people. And now you're teaching it and passionate about helping others. So
yeah, that's ironic. Yeah, but it needed somebody like me who can see it from the beginning that it's gambling to try to teach us so that it's not gambling.
Yeah. Yeah. No, that's great. Very cool stuff. So again, thank you very much.
Thank you, Dominic. Enjoyed it tremendously.
Thank you for listening to this episode of the FI for Kids podcast. Please support the show by hitting subscribe and receive new episodes every Thursday. The intro and exit music this episode are courtesy of Douglas Cameron. As always, you can find links to the FI for Kids music in the show notes. Thanks again, and we'll talk next week.
and brother.